All right, welcome to this episode of Market Shares. I'm your host, Tony Blodgett, and today I have with me Rich Steffens. Rich is a good friend of mine, someone that I've worked together for many, many years, and I'm looking forward to just a brief conversation, talk about the business, talk about how he got in the business, and I'm sure everyone can take away a nugget or two from Rich about how he's been successful for so many years in this industry. So Rich, thanks for taking the time to join me in the studio. And look, we're in a different studio if you haven't noticed. This is down in our Kirkland branch where Rich actually resides. And this is my first episode in the new studio. So this is very cool.
Well, thanks for having me.
Yeah,
Appreciate it.
I'm glad that you made it down. You know, one of the things that we're committed to doing, I'm committed to doing, is helping, all of the loan officers we work with, real estate agents, and other industry professionals who want to have access to video and video marketing to give an environment where we can support that. So I was excited to get this studio built. It's actually a little bit nicer than mine, so now I'm a little bit jealous. I may be coming down here to Kirkland more often.
It's a great studio.
It's a great studio. Yeah. Well, cool. Well, let's get right into it. Rich, we've worked together for a long time, going all the way back to the previous company that we worked at. But let's go back even further. Let's talk about how you got into the industry, what made you choose mortgage banking as your profession, and give us a timeline on kind of when that all took place so we can get a sense of when you got initiated into this crazy business.
Right on. It goes all the way back to 1998 or 97, somewhere around there. I was just getting out of, trying to make a transition in life. I was young, and a good friend of mine owned a mortgage company, and I was actually trying to get back into college as a project management degree. So I was waiting to get back into college, and he said he needed a body, and I needed a paycheck, basically. So it was a subprime company back in the day. Sold lots of 228s and 327s. Hard money, or not hard money, but
there was lots of subprime companies back then.
Yeah, there were. And it kind of morphed into 25 years later. I'm still doing this. So
what was your first role? Like when you first got in the industry, he just needed a body to do what? Did you start as an originator? Or?
I did, yeah. I started as an originator. He was down on a few head counts there. He needed some more people to fill some positions, and so he was a good college buddy of mine, fraternity friend, and so he got me into the business, and it turned out pretty well.
Yeah,
so far
it's been a good industry,
right.
even back then. So subprime was really pretty heavy up until the crash in 2007. Right. Really. Yep. So when did you make a transition from doing more subprime loans to doing more conforming loans? Was it when the market shifted and changed, or was it before that?
No, it was way before that. The subprime route was very difficult. Obviously trying to sell 5.5 points for not a great rate. Yeah. And another friend of mine drug me into the broker world where I was doing conventional, and that's where my things kind of shifted.
Got it.
At that point, yeah. So I didn't really feel comfortable selling those kind of loans. It felt like I was kind of ripping people off.
Well, I feel like, I actually got in the business in 97 as well, so around the same time that you did. And I will admit, I didn't do a lot of subprime, but every time I did one, I felt a little dirty, It was like,
absolutely.
It was kind of a double-edged sword because you were helping a client get into a home that they otherwise couldn't have gotten into, but we all knew the terms were not great. And then you layer on top of that any sort of prepayment penalty and things like that kind of locked people in. Not only was it bad terms, you're kind of stuck with them for a while.
Right.
And then when the market shifted, obviously a lot of people got caught with those loans. And so, no, I like you. I did a few of them, tried to stay away from them. And when I did do them, I said, look, I'm going to put you in this loan, but it's a ticking time bomb. This thing could really explode at any time. And I think that as long as a buyer, with any loan product they go into, even today, they have to have full disclosure. They have to know what they're getting themselves into. Yeah. And that's about the only way I could sleep at night with the few subprime loans.
Yeah. When you say dirty like that, that's what it felt like. Yeah. It's just like it felt really taking advantage of people. So I shifted out of that market space very quickly. And back then, as you probably know, mortgage rates were high. I mean, they were where we're at right now, 7.5%, 8%.
Yeah.
So I was doing a lot of equity lines. It was where second mortgages, people had equity still. Rates were not all that great, but they needed access to cash. So to kind of fill the hopper was doing a lot of equity lines and second mortgages. So
Yeah.
it's kind of that we're in a market kind of similar to that right now, where rates are high and a lot of people are looking to take out some equity, and really the only option if you got a 3% rate or 2%, 2.5% rate, which we refinanced pretty much most people into the last couple of years. It's tough to give that up. So.
Yeah, I think home equity loans are really coming into favor for a lot of people. It's nice to be able to tap into your equity. But as you know, and maybe, for the audience, the challenge with home equity loans is almost all of them are lines of credit and they're tied to the prime rate. Right. And so what happens is especially in the environment we're in right now, is these are adjustable rate mortgages. And as the Fed continues to raise interest rates, which we expect them to probably go at least another 100 basis points, even though the rates are pretty high. Like, what's the rate today on a home equity loan? Do you know, give or take?
6.5 probably.
6.5%.
Yeah, prime plus
and probably going to continue, to go up from there. And so, I think for a lot of people, it's a good for now type of an option. It'll help you tap into your equity. But more than likely, what's going to happen, just like it did in the last cycle, is that when the opportunity presents itself, most people will want to roll those two loans together. And it's kind of a timing thing, right? Like if your rate's at 3.25 and your home equity loan gets up to 8%, at what point does it make sense to roll those two together? Even though you're giving up your super low first mortgage rate, the overall cost, could probably come down and you won't be subject to your second mortgage being
absolutely. It's more of a timing, delaying kind of, hopefully rates come back down to tie those back in together down the road. They'll have to give up that nice low rate to consolidate those, but it's more like delaying, just kind of buying some time with the equity you have in your house to where you can consolidate that again down the road. So
I'm sure when you're talking to clients about these options, I mean, that's part of the conversation, right?
Absolutely.
This is a step, and here we're going to stay in touch, and then we're going to help you get out of this when the time's right.
Absolutely. Yeah.
Very cool. Very cool. So you've been in the business now for 25 years, about the same as me.
Right.
I think that there's probably some lessons you've learned over those 25 years. What's something that you know now that you wish you would have learned earlier on in your career?
That's a very good question. Dedication, I guess, is one. Back then I was more or less kind of just filling space, and now it's a career for me. I was in my probably mid-20s back then. I'm 51 now today, so I've matured a lot over the years. And
well, I think what you're saying is a commitment that this is a full-time job. I mean, I saw a post the other day, one of my past coaches, posted on social media. He said, I don't know the exact quote, but essentially, for those of you that dabble in the mortgage business, like your time is up. Like you can't be a dabbler and just dabble in mortgage origination and think you're going to make it through a market like this. And so I think what I hear you saying is, commit to this being your career. This is a full-time job, and it's challenging. There's so much freedom that is provided to, it's not just loan officers, but real estate professionals as well. I mean, you don't have a boss every day telling you what to do. You're 100% commission. So we kind of get this sense of, hey, we have all this flexibility. We which is nice. We do have flexibility. We can make our own schedule. But what that lends a lot of people to is like, hey, I'm just going to do a couple transactions a month and take the rest of the time off. And that might work when loans are falling from the sky and you're in a refinance market or something like we saw over the last couple of years. But I think this market reminds all of us that this is a job and an industry that requires self-discipline and the commitment to wake up every morning, do the necessary tasks, and it's a full-time job. Can't dabble in mortgage banking.
Absolutely. And we've gone through enough of these cycles over the years of being in the business, 25 years. You've gone through, I don't know, how many of these have we gone through now? So you
a lot.
Times get great, and then times get very, very lean. And so you got to be able to, adapt to the market.
Yeah.
Yeah. And then you got to take strategies you've learned in the past and reapply them today. Some old school techniques, a lot of door knocking now. Technology is a great tool, but sometimes just going back to old school techniques,
Well, you got to meet people, right? You got to meet the phone. You got to talk to people. You got to meet people. You got to go to open houses.
Got to go, yep.
The things that, I used to have a saying that I've changed my mind about this, but I used to tell newer loan officers, like, look, if you're new in the mortgage business, I would work, if you commit to working every weekend for your first year in the mortgage industry, you'll never have to work a weekend again. And I used to say that because I truly felt that way. Like, hey, if you put in the time, you're going to build enough relationships that you can maintain. Then I changed my mindset like in 2008, 9, 10. I'm like, well, I used to believe that, but really what it is there's certain things that you need to do to build your base of business. And when we see a 50% drop in total mortgage transactions like our industry has seen here over the last 12 months, I think you just got to get back to what works. And what works is, unfortunately, you're probably going to have to put in at least a couple hours on the weekend to go to open houses. Look, real estate happens on the weekends, right? Buyers are out looking, realtors are out showing, open houses are happening. Mm-hmm. You kind of have to be committed to being out there doing business while it's taking place and put yourself in front of it. And so I would say if you're not seeing the results that you want in this market, getting back to basics, getting back to what probably got you, to a level of success. And that means putting in a little bit more time, making more phone calls than you probably think you need to.
Making yourself available weekends, weeknights.
That's right.
I always tell my clients, I'm usually up till about 10 o'clock. You can give me a call or shoot me a text. I'm available to you. But after that, I usually shut my phone down. Got to enjoy some private life,
Well, if they're calling you after 10 o'clock at night, there must be like a major catastrophe going on. Right. Well, cool. So let's talk about your clients. Where do you get most of your business? Your referral partners? Do you work with real estate agents or other referral sources? Kind of how have you built your sphere of influence?
Most of your business is going to come from realtors, creating those relationships, going out and seeing them, getting in front of their face, and having them trust you with their transaction. Maybe one or two, you got to kind of go through the path, and then once they get to trusting you, you're their guy at that point, or their person, their mortgage person. So being in the business a long time, you get a large book of business, and a lot of those come back to you. Refer other clients to you, friends and family from them as well. That's mainly been the majority of all my business here this year. It's obviously been slow for everyone, but picking up the phone, reaching out to those old clients and just saying hi, remember what we talked about during their transaction, and just reaching out to them and seeing how they're doing and ask them a question. Maybe that's something that you learned while you're taking their loan application. You got to stay in front of these people, and that's mainly where all my business has been coming from. It's from past clients, referrals from real estate agents and other real estate partners, like insurance, attorneys, divorce attorneys, BK Chapter 13 attorneys.
Yep.
These people still are capable of purchasing, and I've got one going right now in Arizona that it's a BK 13. It's been a challenge, but it didn't having a bankruptcy didn't end their lives. So
yeah, well, I think
so that's another.
Yeah, I think people forget. I mean, and this office in particular does a lot of those. I know Jason does a lot of those, and
right.
and so do you. For those that don't know, if you're in a Chapter 13 debt reorganization bankruptcy, you actually can purchase or refinance your mortgage as long as you've made your last 12 payments on time, and you get permission from the trustee to do so, which typically happens. There's a process, but they usually approve it, and so you can actually purchase a home while you're still in a Chapter 13 bankruptcy.
Yeah.
So, or immediately after discharge, you're eligible as well. Even if you wrapped it up, and it doesn't have the 12 months, but you can pay it off and get it settled, you can immediately obtain financing. So lots of things that people don't realize, and I think we try to specialize in that. One of the things that you said, I think there was something about learning this business 25 years ago where it was really emphasized to me, and I'm sure to you, about building relationships with our clients, this client for life kind of mentality. Right. And I feel like the last couple of years, just because there was so much business and then there was so many refinances, it really commoditized our industry, and it made the relationships much more transactional than actually going deep. And I think folks like you and others who've been doing this for a long time, and I hear this a lot, is, I actually have relationships with my database. They refer me, half your business probably comes from people you've closed a loan from, and that doesn't happen by accident. I mean, you have to plant those seeds, you have to build that rapport, and then you have to actually have relationships with people
after the closing. Right. Yeah, you got to stay in front of them and just check in, like I said, on them, and it will come back to you. And maybe not tomorrow, the next day, next year. I get quite a few clients that come back to me or refer people 2 years ago.
Yeah.
So.
I've had a few referrals this year of people who I closed loans for, and I haven't done a loan since 2012. So sometimes that life cycle can be 10 years later down the road, They're like, hey, do you still do loans? I'm like, well, not exactly, but let me refer you to someone who does. So those relationships are huge. If you're newer in this industry, gosh, you really, I think, it was so feverish pace the last couple of years that we lost sight of that. And if there's one thing I hope younger loan officers take away is the importance of building those relationships and really not even focusing on the commission or the transaction at hand. I mean, it's really the opposite of that, right?
That's the last thing I think about is the paycheck. I just want to get that person to the house or make sure they have the best transaction possible, and then that's going to come back around.
Well, and even if they don't qualify, I mean, making sure that they understand why they don't qualify, helping them with resources to be ready to purchase. I've had referrals from clients I never even closed a loan for just because of the way I treated them, the advice I gave them. And they have friends that, said, hey, I couldn't qualify right now, but I know my friend wants to buy and you were awesome. Maybe you can help them. And so, it's really important not to focus on the commission in this industry. And again, in a refinance market, you kind of lose track of that because you're just tallying up the...
You do. However, I still like to go deep with those clients, even if it seems somewhat transactional, like we have been the last couple of years. I still go deep with those. So that way, they're a client for life. I want to make them a client for life.
Yeah, no, absolutely. So let's talk about your ideal client. Do you work primarily with first-time home buyers, move-up buyers, investors? Do you kind of have a niche that you find yourself working with more often than not?
Not really. Unfortunately, I do a lot of down payment assistance right now because money's kind of hard to come by at times, and low credit scores, and so those down payment assistance loans, they'll pay the bills, I guess, but they're no fun.
They'll pay your bills.
They'll pay my bills. Yeah.
Well,
so I'm really kind of the gamut all across the board. I mean, I've been doing probably more out-of-state loans this year than I have been in-state because a lot of people seem to be relocating.
Oh, yeah.
So jumbos, I mean, conventional, obviously, FHA, down payment assistance. I've really done them all.
Yeah.
And I don't really focus on, say, one specific niche that I focus on.
So it sounds like you first-time home buyers helping kind of challenging situations find solutions to get into a home.
I can. Yeah, absolutely.
Yeah. So, I joke a little bit about down payment assistance loans, and it's because they don't really bring in any revenue, to the organization. Obviously, loan officers, due to loan officer compensation rules, they get paid the same on every loan they bring in the door. But I'll tell you this, I joke about it, but, like anything, it's a relationship, and if you can help someone into their first home, even with a down payment assistance loan, that's a huge win as far as I'm concerned, because that's going to be the client who's going to stick with you for life, and most people are going to do 4 or 5 different houses over their lifetime, refinances in between. That relationship is still very valuable, and so I would never tell a loan officer to shy away from down payment assistance loans because those are sometimes the most loyal clients who are the most thankful that you could help them.
And it becomes another loan down the road because you want to get them out of that assistance because it's recaptured at some point down the road. And
right.
Typically, the rates are not always the most favorable, so it'll be another loan down the road as well.
Yeah.
Just take care of them the first time, and they'll be back.
Yeah, absolutely. So let's shift a little bit and talk about your personal life. I know you're a big outdoorsman. Right. So what do you like to do for fun? When do you find time to fit in the activities you want to do? This is a crazy business. So
yeah. I love the outdoors. I do an annual fishing trip every year to Alaska with my family. This year we caught 93 sockeyes.
What?
Yeah, quite a few. It's our best year ever. And they
were
big.
Do you just set up a booth and start selling those up there, or how do you bring home?
I got a lot hard. Bring home boxes and boxes of salmon.
Wow. And
I usually give quite a few of it away as gifts and here in the office and whatnot. So, but Yeah, it was a great year. Fish were running big. So we got to July trip, third week in July every year. So the things I do are kind of blocked out every year, kind of
Right.
almost the same thing. I do a hunting trip every year to Montana as well as Eastern Washington, and do a lot of deer and elk hunting, outdoor stuff, I grew up in Eastern Washington, so I try to make as many trips out there because I love the Lake Roosevelt out there. Where I grew up on my backyard. Used to skip school and go out water skiing in the afternoon. So, and lots of hiking. I love traveling. My wife and I, we do lots of traveling together. Puerto Vallarta is our destination of choice in Mexico. We go there quite often, and the wife's been working in Hawaii a lot, so we've been having to make some few trips.
Oh, sounds horrible.
Right. So traveling and a lot of outdoor activities is what I enjoy doing.
Well, the thing that you said that I think every loan officer could take from this, or real estate professional, is scheduling out those vacations ahead of time. This is something I learned years ago, and we get so busy in this, even when it's slower, like there's less closings, that means we're busier prospecting or out trying to build our business.
Right.
And you really get head down and focused. And so it really is important to kind of step back.
You got to take time for yourself.
Yeah, and to have those kind of pre-scheduled vacations or trips like that are kind of laid out at the beginning of the year, and that whatever's going on, I'm going to find a way to make that hunting trip happen or that fishing trip happen or whatever. That's a really good reminder. I think that if you're newer in the industry, it's tough to do, but scheduling at least like 4, even if they're just like long weekends, but 4 trips a year, like something every quarter to get out, relax, enjoy
yourself.
Yeah, because this is like a 24/7 kind of a business. It
Absolutely
will
it is, yeah.
run you down if you don't schedule some time.
Yeah. We always do an annual spring Mariner spring training trip as well. Forgot about that
down in Arizona.
Arizona, yeah. Last 3 years we've been off because of COVID, but this year we're going to get back on track and make sure we're down to support our Mariners here this spring.
Okay.
Yeah,
That's
so big sports fan.
That sounds like fun. Well, let's talk about the market that we see today, and then we'll wrap up this episode. So what are the biggest challenges that, like in working with clients and first-time home buyers, what are the biggest challenges that you see in this market? And then let's talk a little bit about how we're overcoming those challenges.
A lot of the challenges are with the low rate environment we've been in. These people were qualifying at such a low rate, and now with rates shifting so far up, a lot of those first-time home buyers or people that are limited with resources don't qualify anymore.
Yeah.
They basically pushed out of the market because the rates are so high. So a lot of those are falling out at this point. And I think it's allowing other buyers who are serious buyers that still has lots of cash sitting on the sideline, making it easier for them to not make an offer, but get an offer accepted. We don't have the 10 or 12.
A little bit less competition.
A lot less competition right
Yeah.
now. So, and obviously you can ask for a lot more from a seller at this point. Closing costs, 2-to-1 buy downs are big right now. Really pushing those with the elevated rate environment we're in. Because a lot of these loans right now we're seeing or we're making these days are going to be short-term loans.
Right.
I figured, once the rates come back down to a not normalized rate, but somewhere where it makes it advantageous to take advantage of a refinance, I figured probably anywhere from 6 to 12, maybe 18 months down the road, they're all going to be coming back. So any businesses I write this year, they're all on my books for as soon as rates start to come back down, we're getting them refinanced. So, So the challenge is obviously the rate environment. I think that's going to be across the board for most people.
Yeah.
Because it's pushing a lot of the buyers out, and there's still a lot of cash sitting on the sideline. I know the cash buyers, I'm not sure if this statistic is correct, but they're outpacing FHA buyers. Right.
Yeah, no, I believe it. And even, Jerome Powell in his statement after the Fed decision last week, he spoke about how much household savings are. We hear a lot about obviously people struggling with inflation and the price of fuel and the price of groceries, all going up. But we still see strong employment numbers, and we still see record amounts of savings that people have. Right. And So, part of what I think is going to happen, and keep in mind, people think that because household debt goes up, like credit card spending goes up, which it is, that doesn't mean that people don't have savings. And so, because we're a society that lives on credit. And so we still do see a lot of savings. What will happen, though, as interest rates continue to go up, that means that there's fixed rate investments that you could put your money into. So even though people have savings, all of a sudden they're going to be like, you know what, I can get 4.5%, I can get 5% in a treasury, I can get 5.5%. There comes a point where people stop spending their money and said, gosh, if I just park it into these fixed return assets, I'm doing pretty good, and that will start pulling money out of the economy, which is what the Fed wants to do. Yeah, exactly. Well, it's going to be interesting. I love what you said about helping people. The biggest challenge first-time homebuyers have right now is affordability, and I think there's lots of tools available right now to help fight that. The problem is like a 2-1 buy down or even a 3-2-1 buy down. I mean, you can take a rate from 7.5 and have them in a start rate of 4.5, but they don't get to qualify at that rate.
Right.
So they get to make the lower payment. That helps the budget, but it doesn't help them qualify for that home. And there really isn't anything these days to do that, because a lot of the programs that allowed you to qualify at a lower start rate or any sort of interim initial rate, those all went away with Dodd-Frank because we don't want to put people into a mortgage that's going to adjust at some point in the near future and then they don't qualify for the payment. So that is, that makes it tough. There's not a lot of great options to help someone qualify for more. You can help bridge the affordability gap in their budget, but you can't really get them into more of a house with the limitations we have today.
That's correct. Right. And the adjustable rates, I mean, you can get in on a start rate of a 7 or 10 year. However, it doesn't seem like the ARM products really are that aggressive these days. So
yeah, I think, with the inverted yield curve, that obviously comes into play with the ARMs. There are some banks and credit unions that offer some pretty aggressive ARM products where they might be, holding that loan in their portfolio and servicing those, but those are few and far between. And, they could be a good option for some. But yeah, the inverted yield curve is going to keep the ARMs on the primary market. I mean, Fannie Mae, Freddie Mac, no appetite for adjustable rate mortgages right now. And I don't think you're going to see that until we see a more normal yield curve. And by the time that happens, rates are going to be back down and they won't really be in favor anyway.
Yeah, exactly. Right. Yeah. Still not going to have the option.
Right on. Well, hey, I appreciate you coming in today. We try to keep these, short, concise, but I love hearing people's stories like yours, 25 years in the business and, starting in subprime, kind of being a dabbler in the industry and then saying, hey, this is a career that regardless of market conditions, I can make the adjustments and continue to, bring in a good income, help my clients, feed my family and have a rewarding career. So congrats to you, for making the adjustments over the years necessary. And thanks to our audience for taking a few minutes to watch this episode. Rich, I appreciate you coming down. I know you don't do a lot of this camera work, so it was wrestling Rich a little bit to get in here and have this conversation with me. But I hope you enjoyed yourself. And those of you watching, if you haven't subscribed to the channel, as you know, we do market commentary, we do interviews with industry experts, we talk to loan officers like Rich, who are just normal, everyday people that'll share their story, and I know there's something that resonates with you. And if you're a newer loan officer, hopefully you found something in Rich's story of 25 years surviving the ups and downs that's going to help you survive in this market. And until next time, thank you for watching Market Shares, and bye for now. Take care.